Well, in today's version of the ET Now Explainer, we are approaching and adopting a very unique topic, one that we don't discuss too often as far as the entire trading strategy or the trading patterns are concerned. In fact, today what we are attempting to explain to you is the dollar carry trade. Now, what it basically means is that this is the dollar carry trade is basically used when there's a significant amount of differential that exists between typically emerging market currencies as well as against the US dollar. So the dollar carry trade refers to a set of foreign exchange transactions that seem to exploit an economic anomaly and entails quite a bit of substantial risk given the fact that adverse currency movements can actually impact the dollar carry trade, especially leverage your dollar carry trade in a significant manner. International investors typically tend to borrow a stronger currency or a currency that is trading higher. Typically, you're talking about the US dollar that sees quite a significant amount of strength. So international investors typically tend to borrow dollars at very low interest rates, and what they actually do is that they would be investing the funds in a higher yielding foreign currency asset in a country that typically has higher interest rates. So the differential that typically exists as far as you're talking about the US dollar and let's say an Indian rupee or any other emerging market currency, you would actually be seeing that this kind of interest rate differential exists. Investors typically do not cover the transaction by selling the projected foreign currency payout in the forward market, which would actually lock in a known return in dollars. Instead, investors typically bet that the dollar would continue to depreciate and or at least not appreciate to such an extent as to actually go ahead and wipe out their gains as far as the interest differential is concerned. Now, what actually happens is that the currencies of countries with low interest rates tend to depreciate, as in the case of the US dollar that we are talking about. On the other hand, typically, you would be seeing emerging market currencies and other currencies typically going ahead and getting weaker against the dollar. So what actually happens is that persistently low US interest rates and dollar depreciation are actually consistent with the ongoing carry trade. This also helps a lot of FI flows to actually enter into emerging markets, and you typically see emerging markets do well when the US dollar weakens. The carry trade, remember earlier, was quite a bit of a darling as far as sophisticated investors was concerned, even pre the 2008 era. And given the fact that this typically tends to benefit from a very low volatility, rather smooth move as far as the US dollar and emerging market currencies are concerned, what investors typically did was that they would be borrowing in low interest rate currencies, and they would then be going ahead and investing in high interest rate currencies, and the spread typically is something was what the gain was. So it's a complicated strategy, but a lot of sophisticated investors typically tend to take advantage of interest rate differentials.